Welcome to another episode of The Pipeline, an S&P Global Market Intelligence podcast that dives deep into the world of M&A and IPOs. I'm your host, Joe Mantone, and on today's episode, I will be discussing the state of the IPO market with Richard Truesdell, the global chair of the capital markets practice at the law firm Davis Polk. Richard is regularly recognized for his work with both issuers and underwriters. He also ranks high on the league tables for the number of IPOs year in and year out. And Richard is a friend of the Pipeline podcast, this being his second appearance. So, Richard, thank you for joining us again.
Sure. Thanks for having me back. I guess I didn't screw it up too much last time.
No, you were great, as always. And Richard and I have spoken a number of times over the years, and it was been very helpful. So I really appreciate that. But when I realized recently, I was looking at your LinkedIn profile, and I noticed that you're celebrating your 40th year at Davis Polk. So just kind of curious to get things started here. Has a lot changed in the industry since you've been here?
So it does show you time flies, but no, it frankly always shocks me how little has changed. I mean, we see technology disrupting industries like the taxi industry. Who'd think technology would disrupt taxis? But securities distribution is 90% the same as it was when I was a first-year associate back in 1986. I guess 1987, I worked on the Charles Schwab IPO. You'd go to the company once a week for drafting sessions. You'd file it with the SEC. They'd come back after 30 days. They'd give you comments no matter how good a job you did. You'd respond to the comments. They'd come back with half as many comments no matter how good an answer you gave. And that went on back and forth a few times until they got tired of you and said, okay, go ahead. And then the bankers would have their roadshow. And at the end of the day, price it based on a book that includes a lot of demand of people who didn't want it filled. So it's a bit of a black arts in terms of how you price it. Half the times it traded up, half the times it traded down. So I think really the only changes of today are we have Edgar. So you no longer have to worry about taking the taxi down to DC in the middle of the night to show up at the filing desk before it opened. And we've got video roadshows as opposed to in person, but all the rest of it is really the same. And I guess the good part of that is I liked doing it 40 years ago and I still like doing it. So luckily it has not gotten sort of commoditized, taking the fun out of it.
Yeah, that is interesting. And I haven't really thought about that before, how it kind of has stayed the same. But it's also crazy that you've been at one firm your whole career or two.
Well, it says something about how nice it is here.
Exactly. But what does change from time to time, and I'm sure you wouldn't argue with this, is the volume of IPOs. And we have been a little bit of a lower volume in recent years for the number of IPOs, but we have seen a bit of an uptick this year. We've seen an increase of IPOs. You and I were talking earlier. You had noted that some of the increase, a good part about it is that it's more broad-based rather than just being one sector driving the recent activity.
Definitely. I think if we look at our pipeline, it's a pretty healthy pipeline that goes across multiple industries. Obviously, AI is a big driver. And by AI, I don't just mean software companies, but anything AI related. So you got data centers, you've got real estate for data centers, you've got anything power related to supply the power for data centers, such as generators, batteries, et cetera. Obviously, chip companies. So you got a whole bunch of industries that are somewhat AI related that are all eagerly looking to access the markets. But fortunately, if the exuberance for AI diminishes, we still have a lot of other stuff in the pipeline for financial service firms, defense contractors. The two historically largest verticals, tech and biotech, are making their comeback slowly. I mean, we're nowhere near the levels that they were at if you went back 4 or 5 years. But we've got deals in the pipeline in pretty much every industry, which is good because investor interest or market demand has been moving around amongst those verticals. So 1 month you'll have a bunch of insurance companies all RFPing up to do an IPO, and insurance seems like the hot new thing. And a month later, we're pencils down on them all and we're on to some other area. So it is good that there's a lot in the pipeline in all the different industries so that even if one industry cools off and investor demand cools off forward, we've got enough other stuff in the other industries to keep the pipeline going.
And then that wasn't the case in the last few years. That wasn't like that. It wasn't so broad-based.
No, it wasn't. And I think particularly if you go back to when the market was going great in like 2021, 40% of that market was biotech, 40% or 30% was tech. So the vast bulk of it was two industries. You didn't see defense contractors. You didn't see much of general industrials. You didn't see much in areas outside those two big areas. So now I think it's more those two that used to dominate the IPO market, biotech and tech, are definitely significantly lower percentage market share than they were before. But I think it's healthier for the IPO market to have companies in other industries as well, so that if you have a footfall, if a couple biotech IPOs in a row don't trade well and everybody backs away from the market, you've still got these other verticals that are doing well.
And what's changed that's really sort of increased the number of sectors IPOing?
I think it's probably in part demand driven. The supply, you've always had issuers in every sector wanting to raise money. So the IPO market tends not to be supply driven that much because there's always the supply. The only thing that changes supply a little bit is just sensitivity to valuation, but it's really more on the demand side. And I think as investors have looked to broaden the industries that they're investing in, have not wanted to have so many eggs in one basket, and have looked to diversification through these other industries, I think we're seeing a meeting up of this new demand, and the supply, I think, again, was probably there before.
So investors looking for more diversification. That's interesting. But it does, and you kind of alluded to this a little bit earlier when you mentioned that the tech IPOs and the biotech IPOs are where they used to be. So it still kind of feels like the IPO market is not firing on all cylinders. So how would you kind of characterize the current state of the IPO market?
I'd say it is better, and maybe I'm just greedy, but not great. It's choppy out there. And so if you just go by dollar volume, SpaceX skewed everything, and it looks like, oh, dollar volume IPOs is huge. If you go by the number of deals, which is, I think, much more representative of the health of the market, it's up. We had 65 sort of traditional IPOs in the first half this year, and that was up from 34, 35 last year. So that's meaningfully up. But compare that to 21. First half of 21, we had 191 IPOs, more than 3 times as many. So we're making our way back. And 2020, 2021 were, if you look over the 10 years, abnormally high, but they're not to a person who's been doing it for 40 years, abnormally high if you went back more than that. If you went back 20 years plus, et cetera, that was the normal level of IPOs. It then trended down, boosted up during COVID, then fell off a cliff. And now we're slowly working our way back up, but we're nowhere near where IPO level was during COVID again. We're at 1/3 of the level. I think if you listen to Chairman Atkins, one of the focuses of the SEC is to make IPOs great again. So we've got a regulatory agenda that's designed to make it easier and encourage companies to go public. And so hopefully momentum will pick up and regulatory flexibility and ease will encourage more companies to access the market.
Yeah. So what's holding back the market from being more conducive for IPOs? Is it regulation? Is it the interest rate outlook complicating the outlook?
So interest rates are definitely a factor. Regulation, if anything's getting easier and better. So that wouldn't account for that might account for the drop off 10 years ago after Sarbanes-Oxley, et cetera, but not today. I think it's more just volatility. IPOs are inherently volatile investments compared to a S&P 500, et cetera. And when we've got sort of the chaos we have going on in the world today with tariffs off and on and war in the Middle East and war in the Ukraine, et cetera, price volatility, oil prices up one day, down the next, that causes a lot of investors to sort of go risk off versus risk on. And when risk is off, one of the first things you shut off are IPOs because they are more risky than your typical investment. So yeah, interest rates are a factor, but I think a lot of it is just the volatility that we're seeing.
Mm-hmm. And then along with, the geopolitical volatility, I mean, you have the performance of SpaceX, which, as you mentioned, it's been one of the biggest stories of the IPO market this year. There's a lot of fanfare around that one, but then the price has slumped and traded below its IPO price for most of July. So would we have a high profile IPO perform like that? Does that take some momentum out of the IPO market?
SpaceX was clearly unique. And because it was unique, I'm not sure it's really that good of a bellwether for the rest of the IPO market. Its trading activity isn't that unsurprising. When you have a high profile company with tons of pent up retail demand, it tends to follow the same pricing trajectory, which is the banks price it off of the institutional demand, not retail. So then all the retail investors put in their orders, it pops in the aftermarket and trades up. All this, interest. And then as the irrational exuberance fades, it drifts its way back down. So they're 10, 15% off the issue price at the moment. But the fact that it popped and it traded back to around the issue price, I don't think it is that surprising. It is unhelpful, particularly for Anthropic, OpenAI, other direct comps. But I think for the rest of the market, it's not that much of an indicator of the health of the market. Obviously, it trading well would have created more excitement and kept people happier. But the fact that it's traded below the issue price, I don't think is going to meaningfully disrupt except for very AI specific, like OpenAI, Anthropic, who are publicly reported as considering delaying their IPOs now. I don't think it's going to have much of an impact on the rest of the IPO pipeline.
Okay, so do you think for those Anthropic type IPOs, you think the bankers and issuers might have to reevaluate their expectations on those deals?
I mean, to put it all in context, at its IPO price, before it traded up at the 135, SpaceX was priced at roughly 100 times revenue. That's just unprecedented. And to put that in context, Meta trades at 9 times revenue, Tesla trades at 16 times revenue. So even though it's traded down 15%, it's still trading over 80 times revenue. To the extent they said, oh, SpaceX priced at 100 and traded up to 150 times revenue, we can get something like that. I think it'll be a benchmark, but I'm not sure even the lower expectations are something to be unhappy with, given that it's still vastly higher than anything else in the tech market, et cetera.
And then, so for more traditional companies that are looking to IPO, you're not seeing much of a change in mindset with them. They're not thinking more about how an IPO might be broken, or they're not having more concerns about going public.
Not from SpaceX, but I think we have had a lot of other high profile, large IPOs break issue price. If you go back through 25, 26, so Figma, Wealthfront, Cerberus, et cetera, there have been a number. So I think people are more focused now on the risk that the stock price doesn't just keep going up. Whether it's right or wrong, the general presumption has been that if you leave a good taste in investors' mouths by having a stock price that pops and stays up, you buy certain goodwill that carries with you for years to come, as opposed to if you trade below the issue price in the near term, you leave a bad taste in investors' mouths that takes a long time to get over. So I do think there's more talk about pricing things conservatively in light of, not really because of SpaceX, which I think, again, is really unique, but because of a large number of other high-profile deals that have not treated as well as people had hoped in the aftermarket.
And has that been because of the geopolitical concerns, or what's driving those IPOs for not performing well?
I'll defer to the bankers on that, because coming back to little has changed in 40 years, pricing an IPO is a really inexact science. When I started for the first 20, whatever years of my career before the Jobs Act, when you couldn't test the waters, I had less than 5 IPOs get to the day of pricing and not price in my entire 25 years. Then every year I have 1 or 2 IPOs get to the day of pricing and not price. So that's after 2 or 3 rounds of testing the waters meetings where the bankers think we can price it here, and you get to the day of pricing and you can't price it. Similarly, in those deals that they can price, just as the deals that couldn't price, they misjudged the demand. I'm not blaming them. I think it's just tough. It's a very inexact science. When they do price it, they price it expecting it to pop. There's the IPO discount that's built in. And I've been to countless pricing meetings where everyone talks about, we think this is going to pop 20% at the open, et cetera. And instead, it's being stabilized by the banks because it wants to break issue right away. So I think there's a lot of just different reasons. Some are company specific, some are market, some are we just mispriced the deal. And if I knew the answer to that, I probably wouldn't be aware. I'd be out being an investor.
I mean, I would think you would be the opposite, that with testing the waters, you'd have fewer deals not priced.
Exactly. That's why it's so counterintuitive to me. I think part of it is people hear what they want to hear. So you have the TTW meeting and the investors are saying, oh yeah, that sounds great. And people take away from that, oh, they're excited, they're going to order. Whereas talk is cheap. They said, yeah, it sounds great, but that's different from saying, put me in for $15 million. And so I think people sort of get too much confidence from the TTW meetings. Because again, literally 1 or 2 deals a year get to the day of pricing, which, is particularly sad after all that work, all that energy. And then typically you can't come back right away because investors are like, well, wait a minute, you couldn't do the deal 3 months ago. Like, what's changed today? So you typically are off the market for roughly a year or so. For the deals that get to the day of pricing and don't price, they typically don't even try to come back for a year.
Wow. Yeah. And that is pretty deflating. I want to ask a little bit about the AI IPOs. With some of these companies, are there sort of increased disclosures or other precautionary steps that these AI companies need to take that you hadn't really seen before come up?
So I think the 2 things are, one, whenever your stock price falls 10% or more around the time of a company announcement, there's a whole bunch of plaintiffs firms that are going to file a lawsuit and then figure out afterwards what their claim is, what's bad in your disclosure. And so for these AI companies, as I said before, IPOs are volatile. IPOs priced at 100 times revenue are even more volatile. And so the odds that they're going to have that 10% price fall are greater. The odds that they're going to have the lawsuit are greater. And therefore, the odds that people will be trying to pick holes in their disclosure are greater. So I think they need to be very careful in all their disclosure to make it as bulletproof as possible. And then two, there's a lot of the industry itself is volatile, is facing a lot of risks, has a lot of issues that all need to be fully addressed. Some industries have fewer issues. Some industries have more issues. AI, obviously, given its nascency, given all of the developments going on, has a lot of stuff that needs to get adequately addressed. But I think the biggest risk really is just it's going to be very volatile. And therefore, people are going to be looking for an excuse to sue you, looking for a claim to say this is what was bad.
Okay, you mentioned earlier that AI was sort of a driver to some of the recent IPOs, and everyone kind of has a bit of an AI story. Are investors sort of distinguishing between companies that truly monetize AI at this point, and from the companies that are just sort of benefiting from the AI adjacent narratives?
So those that are closer, like chip companies, are doing very well. Data centers are doing well. I think it's more when you get into service industries where they're saying, oh, we're going to be more efficient because we use AI, or general industrials. Here's how we can slim down our processes and become more profitable, et cetera. I think investors are taking those tangentially related AI stories with a grain of salt. It doesn't keep issuers from flagging the point and saying how they think AI can help reduce things. But I think investors are taking it with a grain of salt, just like if you went back, whatever it was, 5-6 years ago, when everybody in retail and consumer was suddenly a tech company. And so everybody was positioning themselves as tech because tech had higher multiples than consumer retail did. I think this is a case where whatever your industry, if you can think up how, and AI is going to affect every industry. The question is how soon, and some of the industries have been suffering from it. Software as a service has been suffering, SaaS companies have been suffering, insurance companies have been suffering, where people think AI is going to actually be a competitive threat to them. But for the industries where people can fashion it as a positive and describe the synergies that they're going to get out of it, I think investors, it's a selling point, but I think investors are taking it with a grain of salt till we actually see what's realized.
Okay. Yeah. To kind of wrap things up here, I wanted to talk a little bit about SPACs, which stands for Special Purpose Acquisition Companies. And SPACs are also known as blank check companies, where they raise a bunch of capital and then they use the proceeds to make an acquisition. And the target becomes a publicly traded company. The last time you were on this podcast was May of last year. And at the time, you mentioned that SPACs were making a comeback. And you were onto something, because according to our data, there were more than 100 U.S. SPACs IPOs completed in the first half of the year. And this is the most since 2022. And during the COVID time, we saw a ton of these SPAC IPOs, but the model fell out of favor because of valuation drops and some high profile failures and misaligned incentives. And there was also a bunch of SEC scrutiny around the projections, that they were making. But now they've come back. So what are some of the biggest structural differences between the SPACs that are coming to market now and then the SPACs that we saw in 2020, 2021 during the COVID era?
So first, I would distinguish between the SPAC IPO, which I agree with your numbers, versus the D-SPAC, where they actually acquire someone. We haven't seen a big jump up. So 100 and whatever SPAC IPOs, only 18 D-SPACs, fewer than last year. So in terms of the SPACs actually finding someone to buy, that activity's down.
They're having a hard time putting the capital to work.
Exactly. But in terms of structurally, I think, part of what drove the SPACs out of favor was the economics, was the dilution, was the warrant overhang created by their structure, because they would sell a shared stock stapled to a warrant, et cetera. So the biggest change that we're seeing is most deals now don't have that unit of stock and a warrant, and instead they issue rights. And the difference is it's a right that converts at the time of the de-SPAC transaction. And so therefore, once the merger occurs, you no longer have all this overhang from the warrants that you had in the traditional SPAC structure. So there have been changes like that. And then frankly, just the economics have been more favorable than there used to be. So people are trying to make the economics better, both for investors as well as for the companies that do the de-SPAC. But again, we're not seeing yet the pickup in the de-SPAC activity.
So that difference between the rights and the warrant. So if I'm understanding correctly, that would mean that the investors in the IPO are taking less of a risk when they're, is that
Well, they don't have the optionality. So in the old-fashioned structure, they'd get a warrant, typically to purchase at the same price, but it was good for a number of years and they didn't have to exercise it. So they could wait and see how the company traded before they had to put their money in. Effectively, now it's priced in. They convert at the time of the de-SPAC. They've effectively already paid for it. They don't have that optionality of waiting to see how the de-SPAC company trades for a few years. It was creating overhang that caused other investors to say, well, gee, there's all these warrants that could be exercised and dilute me down.
I see. I see. So, but why do you think we're seeing more of the IPOs if we're not seeing the actual acquisitions?
Because they're two different classes of investors, right? So it's the IPO buyers are people who figure, well, worst case, I get my money back if I don't like the de-SPAC, et cetera. Interest rates are relatively low still. So here's I get some optionality. I'll park it here. I think there continues to be concern on the issuer side of a de-SPAC transaction is more expensive than doing a traditional IPO from a dilution perspective, et cetera. And so to the extent that we're making IPOs great again, to the extent that the IPO market is open, the de-SPAC is especially favored when either the IPO market isn't doing great, or B, for companies that need to use projections, need to do stuff that you can't really do in an IPO to tell their story.
Can some of these SPACs, can they help with the private equity exit problem? Exits for private equity firms has been slower than than the industry would like.
We really haven't seen, there's been a couple examples of private equity using a de-SPAC, but we really haven't seen the private equity firms use it as a tool. I think it's frankly just because they're shrewder and they don't want the dilution and the cost, that they recognize they've got multiple ways to exit. It could be a trade sale, it could be an IPO, et cetera. An IPO is cheaper from a dilution perspective to the sponsor than a de-SPAC. Most of the private equity IPOs we're doing these days are all dual tranche. It's a side-by-side M&A sale, might be to another private equity firm or could be to a strategic, et cetera, and an IPO. And then they just sit back at the end and say which market's offering better value. And they'll pick based on that. So we are seeing more PE IPOs in the pipeline, but they just have not really used the de-SPAC market.
Okay. Well, that's interesting that you're seeing more PE IPOs in the pipeline. Are the PE firms getting more comfortable with the valuations, or is it more what you said? Are they getting sort of that dual track optionality? Is that more of a catalyst for them to look at IPOs?
I think it's all of the above, and also time. Like they've been sitting on the sidelines waiting for things to improve. You can only sit on the sidelines for so long. Two, they're being selective in calling their shots. So in industries that are doing better on the valuation front, say defense contractors, et cetera, there's more in the pipeline in those industries that are showing better IPO valuations. And then three, they're again doing most of the deals as a dual track. We want to exit this business one way or the other. So let's consider all the alternatives. And unfortunately for a capital markets lawyer, a lot of those dual tracks have ended up as a sale. So you never find out about the IPO, but at least it's good that they're looking to monetize and good that they shot at the IPO anyway.
Right. As long as the client is happy in the end, that's all that matters. Right.
Exactly. Yep.
Okay, Richard. Well, I think that's a good point to end on. So, I thank you very much for joining us today. And I thank everyone for tuning in and listening.
Thanks for having me on and hope to see you next year.
Take care. Thanks. Bye.